Major exchange says zero delivery. What's really breaking in the silver market? An announcement just dropped from one of the world's largest commodity exchanges, and if you grasp what it actually means, it fundamentally reshapes how you understand price discovery in commodity markets. Starting at the end of February, anyone trading on the Shanghai Futures Exchange who isn't classified as a hedger will be allocated exactly 0 lots for physical delivery on silver contract, not a reduced amount, not tighter restrictions, absolute 0. Let me be clear about what this signals. Exchanges don't cut delivery allocation to 0 when everything's running smoothly. They impose that kind of restriction when they cannot guarantee the underlying commodity will actually be available for settlement. And this isn't happening in isolation. Across the Pacific, vaults are bleeding inventory. Borrowing costs for silver are spiking. And for the first time in years, even mainstream financial outlets are quietly acknowledging what's been obvious in the data for months. There are genuine constraints in silver supply. Today, I want to walk you through what's actually unfolding beneath the surface of this market. Not the daily price movements that dominate headlines, but the structural dynamics, the story of what happens when the paper trading system that determines prices begins to separate from the physical delivery system that actually moves metal. Because that separation is no longer hypothetical, it's visible in the data, and the implications reach far beyond silver itself, touching how we understand commodity pricing, market integrity, and what you actually own when you hold a financial claim versus a physical asset. Before we dive deeper, let me be absolutely transparent about what this content is and what it isn't. This is educational analysis. I'm presenting my interpretation of publicly available exchange data, regulatory filings, and institutional research. This is not financial advice. I will never ask you for money, sell you courses, offer trading signals, or run paid groups. If anyone using my name or likeness tries to sell you anything, it's a scam. Report it. Now let's examine the numbers, because the data itself tells a compelling story. The price gap that shouldn't exist. Here's the current market snapshot as of this recording. Silver spot price in Western markets, approximately 32.90. Shanghai spot price, 33.7. Shanghai futures, 34.29. That represents a $3.77 premium for the exact same metal, just traded in different geographical locations. In a properly functioning global market with efficient capital flows, this kind of arbitrage opportunity shouldn't persist. The mechanism is straightforward. Traders buy silver where it's cheaper, ship it to where it's more expensive, sell it there, and pocket the spread. That activity should compress the price gap until it reflects nothing more than transportation and transaction costs. But the gap isn't compressing, it's persisting. Day after day, week after week, month after month, Shanghai silver consistently trades at a premium to Western spot prices. Here's what makes this significant. The premium exists because the arbitrage mechanism that should eliminate it is breaking down. And the arbitrage mechanism is breaking down because the physical metal required to close that gap either isn't available in sufficient quantity or cannot move freely enough between regions to equalize prices. When an arbitrage gap persists in a commodity market, it's not a technical glitch or a temporary inefficiency. It's information. The market is communicating that the physical world and the paper world are operating under fundamentally different constraints, and the physical world is asserting dominance. This isn't speculation or theory. The Shanghai Gold Exchange publishes this data daily. Anyone can verify these numbers. The premiums are tracked, documented, and publicly available. The account suspensions, nobody's talking about. While that price differential continues, something else noteworthy is happening at the Shanghai Futures Exchange that deserves your attention. Over the past 7 days, the SHFE has suspended 20 groups of trading accounts for regulatory violations. 20 account suspensions in 1 week on a major global commodity exchange. That's not routine compliance enforcement. That's not standard housekeeping. Exchanges don't suspend accounts in clusters like this during normal market conditions. They implement mass suspensions when trading activity is creating systemic risk, when positions become dangerously concentrated, when participants can't meet delivery obligations, when the settlement process itself is threatened. Article 16 of the SHFE regulation framework governs these suspension protocols. It's public documentation. Anyone can access and verify it. Now connect these two developments. 20 account suspensions in the same week that the exchange announces zero delivery allocation for non-commercial participants starting end of February. What emerges is a picture of an exchange actively managing a situation where demand for physical settlement is exceeding or threatening to exceed available inventory. This is the part of market structure most people never see. Exchanges don't just facilitate price discovery, They manage delivery logistics, and when delivery capacity becomes the binding constraint, the rules start changing in ways that reveal the underlying stress in the system. If you find value in understanding what exchange-level data actually reveals about market structure rather than just watching price tickers, that's exactly what this channel focuses on. Consider subscribing if this approach to financial education resonates with you. What's happening in American vaults? Now let's shift our focus across the Pacific to examine what's unfolding in the United States, because the numbers here tell a complementary and equally revealing story. COMEX, America's primary precious metals futures exchange, reported that 861,000 ounces of silver exited its warehouses yesterday. In a single day, March delivery contracts are being closed out and rolled forward at an accelerated rate, which is typical behavior as a delivery month approaches. If the current pace of contract rolling continues, there should theoretically be adequate silver in COMEX vaults to satisfy March delivery demand. But, and this is critically important, let's examine the coverage ratio. Current open interest sits at approximately 68,000 contracts. Each contract represents 5,000 ounces of silver. That translates to roughly 340 million ounces of paper silver claims outstanding. Registered silver, the actual metal that's been earmarked and is available for physical delivery, currently stands at about 101 million ounces. That's 3.4 paper claims for every single ounce of deliverable metal. Now, I want to be intellectually rigorous here because this metric gets misrepresented and misused in commentary. Open interest does not equal delivery demand. The vast majority of futures contracts never go to physical settlement. They get rolled forward, closed out, or cash settled. That's how the futures system has functioned for decades. The mere existence of a 3-to-1 coverage ratio doesn't mean COMEX is going to fail tomorrow morning. But here's what it does definitively mean. The system is leveraged. It operates on confidence, specifically the confidence that most market participants will accept cash settlement rather than demanding physical metal. And confidence, as we've observed across numerous markets throughout financial history, is not a permanent state. It's a psychological condition that can shift rapidly when circumstances change. The fundamental misunderstanding about futures exchanges. Most people operate under a fundamental misunderstanding about what a futures exchange actually is. They assume it's essentially a marketplace for physical commodities, that the price displayed on COMEX represents what silver is genuinely worth, and that anyone seeking metal can obtain it at that quoted price. In reality, COMEX is primarily a financial derivatives marketplace. It's a sophisticated system for managing price risk through paper instruments. Physical delivery is technically possible, but it's the exception, not the norm. The price it generates reflects financial positioning, leverage ratios, hedging strategies, algorithmic trading flows, speculative bets, as much as it reflects genuine physical supply and demand dynamics. This distinction doesn't particularly matter when vault inventories are abundant, but when vaults start draining, when coverage ratios stretch thin, when exchanges on the other side of the world start restricting physical delivery, this distinction becomes the entire story. When Bloomberg quietly admits what the data has been showing, something caught my attention this week, and it caught my attention specifically because of the source. Bloomberg, not some alternative financial blog, not a precious metals YouTube channel, but Bloomberg Television, ran coverage on surging gold demand in Hong Kong ahead of Lunar New Year celebrations. Standard seasonal story: retail buyers purchasing small bars and coins as gifts, trading volume significantly elevated compared to last year. But buried in the middle of that coverage was a single line that most viewers probably scrolled past without registering its significance. Supply constraints, especially in silver, are raising concerns about whether the momentum can last. Supply constraints in silver, from Bloomberg. They also published a standalone article describing what they termed China's big silver squeeze, persisting even as prices stabilize. Mainstream financial media is now acknowledging, in print and on air, what exchange data has been screaming for months. But notice the framing. It's not the headline, it's not the lead paragraph, it's a qualifying line embedded in the middle of a holiday shopping feature story. It's there if you're actively looking for it, invisible if you're not. This is precisely how major structural shifts get reported in their early stages, not with alarm bells and urgent warnings, but with footnotes and buried qualifiers. The framework that makes sense of the data. Let me introduce an analytical framework that helps organize all these individual data points into a coherent picture. Analyst David Jensen recently published research on what he terms silver depletion, the systematic draining of Western vault inventories, and the simultaneous global tightening of physical silver availability. His core thesis is straightforward and data-driven. This isn't just COMEX experiencing inventory decline. This isn't just the London Bullion Market Association seeing withdrawals. Silver vaults are depleting simultaneously across multiple exchanges, across different geographical regions, all at once. And the cause, in his analysis, is structural rather than cyclical. Decades of consumption exceeding production. The world has been using more silver than it mines, year after year, consistently drawing down above-ground stockpiles to bridge the supply gap. 5 consecutive years of structural supply deficit. A cumulative shortfall now approaching 800 million ounces, nearly an entire year of global mine production, simply consumed and removed from available inventory. His conclusion about where this trajectory leads, and I'm paraphrasing his research here, is that anyone expressing concern about the current pace of price appreciation or silver's recent volatility hasn't seen anything yet relative to what's coming. Now, I want to be cautious with that kind of statement because it can easily sound like sensationalism or hype. So let me reframe it in more analytical terms. When you have a commodity experiencing accelerating industrial demand, solar panel manufacturing, electric vehicle production, AI data center infrastructure, 5G network build-out, defense applications, and that demand is largely price inelastic because manufacturers require silver specifically for its unique physical properties regardless of cost, and you simultaneously have constrained supply because bringing a new silver mine online requires 7 to 15 years from discovery to production, and ore grades at existing operations are declining, and you layer investment demand on top of industrial consumption from institutions and individuals, increasingly treating silver as a monetary asset and inflation hedge. The mathematics only resolve one direction, through substantially higher prices. Not because of speculation or mania, but because that's the fundamental mechanism through which supply and demand achieve equilibrium when supply is physically constrained. That's not a prediction. That's how commodity markets have always functioned throughout economic history. Maybe it's not metals that are in a bubble. The prevailing media narrative around precious metals, price movements tends to follow a predictable script. Prices rise sharply. Media declares it a speculative bubble. Prices correct. Media says the bubble has popped. Prices recover. Media says speculators are back at it again. But there's an alternative interpretation that fits the empirical data considerably better. What if these price increases aren't speculative excess, but rather the gradual, messy, volatile process of a commodity repricing itself to reflect a genuine, multi-year supply deficit that's been building beneath the surface? Consider this perspective. The S&P 500 priced in gold terms has been in a declining trend for more than 2 decades, down approximately 60% over a 25-year period. Think about what that means. The greatest companies in human history, generating record profits, innovating at unprecedented speed, deploying cutting-edge technology, are still underperforming a shiny metal that sits inert in a vault generating zero cash flow. Maybe the relevant question isn't whether precious metals are in a bubble. Maybe the question is whether paper financial assets denominated in actively debased fiat currencies are the thing that's fundamentally mispriced. The bearish case deserves respect, too. I want to pause here and do something I consider essential, even though it's uncomfortable and might hurt engagement. I want to present the bearish counter-argument with intellectual honesty, because if you're only hearing one side of an analysis, you're not being educated, you're being sold a narrative. Silver 1-month lease rates recently dropped to 2.69% after exhibiting 4% to 6% daily volatility swings. That kind of dramatic volatility in lease rates can indicate short-term position unwinding or temporary market dislocations that don't necessarily signal a permanent shortage. The March COMEX delivery might actually proceed without incident if the current contract rolling pace continues. We've witnessed situations before where the advanced mathematics looked absolutely terrifying, yet the delivery month arrived and passed without dramatic failures. The system has built-in mechanisms, contract rolling, cash settlement options, position limits, specifically designed to prevent the catastrophic failures that doomsday scenarios envision. The Shanghai premium, while currently elevated at 377, has been higher during previous market cycles. This isn't unprecedented territory, and Bank of America's recent warning about bubble-like behavior in precious metals isn't meaningless noise. Assets that appreciate too far too fast absolutely can and do correct violently regardless of underlying fundamental support. We've observed this pattern across every asset class throughout market history. Momentum reverses. Corrections can be brutal. Price can disconnect from fundamentals in both directions, excessive optimism and excessive pessimism. There's also a deeper, more uncomfortable bearish argument that deserves genuine respect. Paper markets possess tools to suppress prices that can persist far longer than most investors expect or can financially endure. Concentrated short positions, sophisticated derivative structures, coordinated intervention by major financial institutions. These price suppression mechanisms have historically persisted for years, even decades, before finally breaking. The 2020 JP Morgan settlement, $920 million in fines for systematic precious metals manipulation, definitively proved that large-scale price manipulation is real, documented, and admitted in court proceedings. But it also proved something else equally important. Manipulation can continue for an extraordinarily long time before consequences arrive. JP Morgan paid nearly $1 billion in fines, and personnel at those same trading desks continued operating. If you are anticipating imminent resolution where manipulation suddenly ends and free market price discovery begins next Tuesday, you might be setting yourself up for years of frustration and disappointment. What the $920 million settlement actually reveals. There's a comfortable assumption embedded in how most people conceptualize markets, that prices are always and everywhere the result of fair, transparent supply and demand dynamics operating freely, that the number displayed on your screen represents objective truth about an asset's value. Historical evidence suggests otherwise. The $920 million JP Morgan settlement provides documented proof that major financial institutions can and do systematically manipulate commodity prices for years while treating regulatory fines as merely a cost of doing business. This doesn't mean every single price movement is manipulated, but it definitively means that the price on your screen might not reflect what that commodity would trade for in a genuinely unmanipulated market operating with true price discovery. And that gap between the administered price set by paper markets and the true equilibrium price demanded by physical supply-demand dynamics is precisely what the Shanghai premium, the vault inventory drains, and the delivery restrictions are measuring in real time. The physical market is increasingly establishing its own price, and that price is demonstrably higher than what Western paper markets quote. The pattern that plays out, almost every day. There's a subtle pattern worth noting that unfolds almost daily in precious metals markets, and it's subtle enough that most market participants don't connect the dots. During Asian trading hours, commodity prices, gold, silver, platinum, tend to move higher. Prices get bid up overnight as Eastern markets actively trade physical metal. Then New York trading opens, and prices systematically get pushed back down. This pattern has repeated for years with remarkable consistency. Asian physical markets bid up real metal. Western paper markets suppress prices back down through derivatives trading. But the pattern is showing cracks and failures. The Shanghai premium exists precisely because that Western suppression mechanism is no longer fully functioning. Eastern buyers are paying significantly more for physical metal, regardless of what New York derivatives screens display. The arbitrage mechanism that should eliminate the price gap cannot function, because the physical metal required to execute that arbitrage isn't available to move. When a pricing mechanism fundamentally depends on arbitrage, and arbitrage depends on available supply to physically move, and that supply starts running critically short, the entire pricing mechanism begins breaking down. When two major banks publish opposite conclusions in the same week, this is where two Wall Street institutions publishing contradictory research calls in the same week starts making perfect sense. Bank of America warns clients about bubble-like behavior in precious metals markets. Wells Fargo, in that exact same week, raises their gold price target to $3,300, representing over 20% upside from current levels, citing geopolitical risks, financial market volatility, and exceptionally strong central bank demand. They specifically characterized the recent pullback as a healthy correction and an attractive buying opportunity. Two major banking institutions. Same week. Completely opposite conclusions. That doesn't necessarily mean one is correct and one is wrong. It means the system is in a state of genuine structural uncertainty, where traditional models don't cleanly apply anymore, and the emerging new reality hasn't been fully incorporated into prices yet. If you appreciate analytical content that presents both bullish and bearish perspectives, that treats you as someone intellectually capable of weighing evidence rather than passively accepting conclusions, this channel is specifically built for you. We focus on primary source documents, verifiable data, and analytical frameworks for independent understanding. Subscribe if that's the kind of financial content you've been searching for. Your practical verification checklist. Let me provide you with something immediately actionable, not a conclusion, but a verification checklist. Because in a market environment that's saturated with noise, the critical difference between genuine understanding and confusion typically comes down to whether you're examining primary sources or consuming secondhand interpretations. Here's what you can verify right now, today, using publicly available data. 1. The SHFE Delivery Restriction Announcement. Official exchange policy documentation. Zero lot allocation for non-hedging participants commencing end of February. This is not rumor or speculation. It's a formal regulatory filing accessible to anyone. 2. COMEX Registered Silver Inventory. Updated daily. Publicly available data. Currently approximately 101 million ounces of registered silver against 340 million ounces of open interest exposure. You can track the inventory trend yourself over days, weeks, and months. The Shanghai Premium. Published daily by the Shanghai Gold Exchange. Track this metric over weeks rather than individual days. If it persists or widens, it's communicating that physical and paper markets are actively diverging. If it compresses towards zero, it suggests the arbitrage mechanism is functioning again. 4. Bloomberg's supply constraint reporting. It's documented in their published coverage, not in headlines, but in the substantive middle paragraphs of articles. It's there, it's attributable, and it's coming from mainstream financial media. 5. Silver lease rate volatility. Published by multiple financial data services. When lease rates spike sharply, it signals someone urgently needs to borrow physical metal, often because they're facing delivery obligations. When rates normalize, immediate pressure has eased. Watch the pattern over time, not individual data points. None of these individual data points, examined in isolation, proves anything definitive. Markets are extraordinarily complex systems. Single indicators frequently mislead. But when multiple independent data points, originating from different exchanges, different geographical regions, different categories of market participants, all converge pointing in the same direction, that convergence carries genuine informational weight. The SHFE restricting delivery to zero. COMEX inventories declining week after week. Shanghai premiums persisting month after month. Bloomberg acknowledging supply constraints. Vault stocks depleting globally across regions. These aren't separate, unrelated stories. They're different observational angles on the same underlying structural reality. What your bank account number actually represents. Most of us were raised with an elegantly simple mental model about wealth. You earn money through labor. You deposit it in a bank. The number displayed in your account represents your wealth. The financial system handles everything else automatically. But what that simplified model fundamentally obscures is this critical fact. The number in your account is denominated in something, a currency whose purchasing power is a policy decision made by central bankers and politicians, not a law of physics or nature. When that currency is being actively expanded through massive fiscal deficits and central bank balance sheet operations, the numerical value stays the same, but what that number can actually purchase in the real economy changes dramatically. Understanding the relationship between paper claims and physical reality isn't some niche precious metals hobby. It's a foundational financial literacy skill that applies across all asset classes. Whether or not you ever purchase an ounce of silver in your lifetime, understanding why a major commodity exchange would restrict physical delivery to absolute zero, and what that reveals about the divergence between paper prices and physical availability, makes you a more sophisticated, informed participant in the global financial system. The people who diligently check primary sources, who independently verify exchange regulatory filings, who systematically track vault inventory data, they're not doing this because they're contrarian by personality. They're doing it because they've learned through experience that the most important information in financial markets is usually the information that doesn't make the headline. You cannot print physical metal. Here's the fundamental dynamic I keep returning to. You can create infinite paper contracts. You can manufacture infinite derivative instruments. You can leverage synthetic exposure to any degree financial regulators permit. The modern financial system is extraordinarily sophisticated at manufacturing claims on underlying assets, but you cannot print physical metal. You cannot conjure silver out of thin air through monetary policy. And when actual buyers, whether they're industrial manufacturers requiring silver for solar panel production, or major institutions like Tether accumulating massive gold reserves in Swiss vaults, or Chinese retail investors willingly paying persistent premiums that defy Western spot pricing, when these buyers increasingly demand the physical commodity rather than accepting paper claims as substitutes, the entire pricing mechanism faces a stress test it was never designed to withstand. That stress test isn't manifesting all at once in a single dramatic market event. It's unfolding gradually, regionally, incrementally, in the form of persistent price premiums, delivery allocation restrictions, vault inventory depletions, and quiet acknowledgements buried in Bloomberg article paragraphs. The fundamental question isn't whether this matters. The question is whether you're paying active attention to the primary sources, the exchange regulatory filings, the vault inventory reports, the policy changes, or passively waiting for a comfortable mainstream headline that explains everything after the structural shift has already occurred. The data is publicly accessible, the sources are independently verifiable, the structural forces are patient, methodical, and completely indifferent to anyone's preferred timeline or expectations. Don't trust me. Verify everything. Don't trust my interpretation. Don't trust the mainstream financial media narrative. Trust primary source documents and verify independently. If you're the type of person who reads the actual regulatory filing before accepting the headline summary, who genuinely wants to understand the underlying machinery of how markets function rather than simply reacting to price outputs, you're already thinking fundamentally differently than the vast majority of market participants. Subscribing to this channel is a practical way of staying connected to that analytical approach and methodology. If this analysis gave you a useful framework for thinking critically about the gap between paper prices and physical reality, if it helped you identify which data points actually matter and where to locate them independently, then this was a valuable use of your time. Drop a comment letting me know which aspect of this analysis you found most valuable, or which market dynamic you want me to break down next. Hit that like button if this kind of deep primary source analysis is what you're looking for. I'll see you in the next one. Japan currently has the highest interest rates they've seen in about 30 years. For Japanese homeowners with variable mortgages, payments are rising right now. Here's the systemic risk. If payments rise faster than incomes, people default. When defaults increase, home prices fall. When home prices fall, banks holding mortgage collateral become undercapitalized. When banks weaken, they stop lending. When lending contracts, the economy slows. More people lose jobs and default. Sound familiar? This is exactly what triggered the 2008 financial crisis in America. Japan's mortgage structure makes them vulnerable to the same cascade. The government knows this, which makes the February 8th decision even more difficult. Raise rates to fight inflation, but risk mortgage defaults and bank failures. Keep rates low to prevent defaults, but let inflation destroy purchasing power. There's no good answer. The Treasury Connection. Here's the final piece that connects directly to American finances. Japan holds approximately $1.2 trillion in U.S. Treasury securities, making them the largest foreign holder of American debt. During Japan's decades of negative interest rates, Japanese investors looking for any positive return bought American treasuries. Even a small positive yield was better than negative yields at home. This created a perfect arrangement. The U.S. government needed buyers for its bonds, and Japan needed somewhere to invest. But now, conditions are changing. If Japan keeps raising interest rates, Japanese government bonds start offering competitive yields. Japanese investors no longer need to accept currency risk and invest abroad to earn positive returns. They can invest at home. If Japanese investors shift from American treasuries to Japanese bonds, that's $1.2 trillion in demand for American debt that could disappear. When demand for treasury securities falls, prices fall and yields rise. Rising treasury yields affect everything. Mortgage rates go up, corporate borrowing costs increase, government debt payments explode, and stock markets often fall as bonds become more attractive. Japan's decision about their own monetary policy has direct implications for American interest rates, housing costs, corporate profits, and government finances. The two economies are deeply connected, and that $1.2 trillion in treasury holdings is the link. What this means for you. Look, I'm not going to tell you what to do with your money. That's not my job. My goal is to help you understand how the system actually works so you can make better decisions for yourself. But here are some frameworks worth considering. Geographic diversification may matter less than you think. If Japanese monetary policy affects American stocks, owning both Japanese and American assets doesn't fully protect you. The same dynamics move both. Interest rate sensitivity matters more when rates are actually changing. After years of near-zero rates, many assets were priced assuming that would last forever. As rates normalize, those assumptions get tested. Currency exposure is real. If you hold assets influenced by yen dynamics, currency movements directly affect your returns. And debt levels constrain options. Countries with massive debt have fewer tools when problems arise. They can't easily stimulate if they're already borrowing heavily. The bottom line. Japan's February 8th decision matters because it reveals the core tension in modern monetary policy. 30 years of fighting deflation created a debt burden that now limits options for fighting inflation. Negative rates that seem sustainable without inflation become impossible when inflation arrives. Capital flows that supported American asset prices could reverse. Treasury holdings that funded American deficits could shift. None of this is certain, but the structural dynamics are worth understanding, because whether or not this particular decision triggers immediate consequences, the underlying tensions between debt, inflation, and growth will keep shaping markets for years. This is what I do on this channel. I break down the mechanics, I explain the connections, I help you think in systems rather than react to headlines. Because understanding how the system works before you need to react is the foundation of making decisions you won't regret. If you found this valuable, hit that like button and drop a comment letting me know what financial topic you want me to break down next, and subscribe so you don't miss the next one. Thanks for watching.